Most people believe that saving money is the responsible thing to do. Put cash in a savings account, watch the balance grow, and feel secure. But there's a problem with this logic that becomes obvious once the mechanics of modern money are understood. By the end of this video, it will be clear why saving alone is not a wealth-building strategy, and why the top financial minds operate under a completely different framework. And this isn't about motivation or get-rich schemes. This is about understanding how money actually behaves in the real economy, and why that behavior punishes those who don't adapt to it. Here's the core issue. Money sitting in a bank account is not static. It doesn't hold its value the way a brick holds its shape, or a gallon of water holds its volume. Money is a claim on goods and services, and the purchasing power of that claim changes over time. When inflation runs at 3% annually, a dollar today will only buy what 97 cents bought last year. After 10 years, that same dollar buys roughly 74 cents worth of goods. After 30 years, it's worth about 40 cents. The number in the account stays the same, but what it can purchase shrinks consistently and predictably. This is not a theoretical problem. It's measurable and constant. The Federal Reserve targets 2% inflation as policy, which means the purchasing power of cash is designed to erode slowly by default. Central banks do this intentionally to encourage spending and borrowing, which drives economic activity. But for individuals trying to build wealth, this creates a hidden cost. Saving $10,000 and letting it sit for a decade means losing roughly $2,000 in real value, even if the account balance never changes. Most savings accounts offer interest rates below 1%. Even high-yield savings accounts rarely exceed 4 or 5% in favourable conditions. When inflation is running at 3 to 4%, the real return after accounting for purchasing power loss is close to zero, or even negative. This means that someone who diligently saves cash is treading water at best, and slowly sinking at worst. The account balance might grow nominally, but the ability to convert that balance into real goods and services does not keep pace. The wealthy understand this distinction clearly. They do not hold large amounts of cash unless it serves a specific short-term purpose. Instead, they convert money into assets that either generate income or appreciate faster than inflation erodes value. Real estate, equities, businesses, and other productive assets are designed to grow in nominal value over time, ideally outpacing the rate at which money loses purchasing power. This is not speculation, it's a systematic response to how the monetary system functions. Consider a simple comparison. Someone saves $50,000 over 10 years and keeps it in a savings account earning 0.5% annually. At the end of that period, the account holds roughly $52,500. But if inflation averaged 3% during that time, the purchasing power of that $52,000 is equivalent to about $39,000 in today's terms. Nearly $11,000 of real value evaporated, despite the account balance increasing. Now consider the alternative. That same $50,000 invested in a diversified portfolio of stocks, historically returning around 7 to 10% annually before inflation, would grow to roughly $97,000 over the same 10 years at a 7% return. After adjusting for inflation, the real value is approximately $72,000 in today's purchasing power. The difference is not trivial. One approach loses value silently, the other builds it systematically. This is not about taking excessive risk. It's about recognizing that holding cash carries its own risk, the risk of guaranteed purchasing power loss. The safest feeling option, keeping money in a bank, is actually the option most certain to result in wealth erosion over time. This inversion is not intuitive, which is why it's rarely taught and widely misunderstood. The system is structured this way for a reason. Governments and central banks benefit when money circulates and when debt is cheap. Savers who hoard cash are, in effect, subsidizing borrowers and spenders. Every year that inflation runs above the interest rate on savings, wealth transfers quietly from those holding cash to those holding assets or using leverage intelligently. This transfer is invisible on a day-to-day basis, but compounds powerfully over decades. There's another layer to this. Lifestyle inflation works in tandem with monetary inflation to keep people financially stagnant. As income rises, spending often rises to match or exceed it. The difference gets saved in cash, which then loses value. The cycle repeats. Someone earning $60,000 a year might feel wealthier than they did earning $40,000. But if their expenses rose from $30,000 to $50,000 and the extra savings sit in cash losing purchasing power, the net effect is minimal. They're working harder, earning more, and still not building wealth. Breaking this pattern requires a shift in how money is treated after it's earned. Income is the starting point, not the finish line. What happens to that income in the hours, days, and months after it arrives determines whether wealth accumulates or dissipates. Saving is necessary, but only as a buffer for short-term needs and emergencies. Beyond that, money must be deployed into systems that preserve and grow its value faster than inflation erodes it. This is the framework the top financial minds operate within. They think in terms of purchasing power, not account balances. They think in terms of assets, not savings. They understand that the rules of the game are written to favour those who move money into productive use, and to penalise those who let it sit idle. This isn't insider knowledge, it's just mechanics, but mechanics that most people never learn because the education system teaches saving as virtue without explaining the underlying dynamics of what money actually does over time. Understanding this changes the entire approach to personal finance. It reframes saving from a goal into a temporary holding pattern. It reframes investing from optional to essential, and it makes clear why those who build lasting wealth operate under assumptions that look nothing like conventional financial advice. This is part of an ongoing series on how money really works. If this perspective is useful, subscribe to continue exploring the systems, behaviours, and structures that separate those who build wealth from those who work hard but stay in place.